Well, our next guest says the sovereign debt crisis in Europe is having a dampening effect on the global M&A markets. Frank Aquila is a partner at Sullivan Cromwell's mergers and acquisitions team. He serves as a regular advisor to such global leaders as Amgen, Anheuser-Busch, British Airways, and Diageo. Frank, welcome back to Bloomberg. Always good to see you.
Good to see you.
You're saying that it's having a dampening effect, but also a sobering effect as well?
Well, I think it's having a dampening effect because M&A happens in periods when there's certainty. And the last few weeks, because of the sovereign debt crisis, there's been a fair degree of volatility. And in particular, it's having a lot of volatility, not just in the U.S., but particularly in Europe, where there are questions about the euro and what the future is going to be and what that means for economic growth there.
But that doesn't mean that there's not a lot of interest, correct?
Oh, absolutely. There's tremendous amount of interest. I think, overall, there's really a great opportunity for strategic consolidation. And I think that once the volatility dampens down, once you see the VIX come down, you'll see M&A activity rise, although I think we're going to see it rise here in the U.S. and in the rest of the world before we see a lot of European-based M&A activity.
Well, what about cross-border activity? I mean, do you think we'll see a lot of U.S. firms look to Europe, see perhaps some good valuations for strategic deals at this point, and maybe some deals going that way?
There certainly could be. I think, Julie, one of the things I would look for in terms of cross-border activity later this year and early next year is U.S. to Asia, Asia to North America, Asia to South America, Brazil to Asia, places like that. I think there will be, M&A activity into and out of Europe, no doubt, but I think we're going to see other areas of the world actually be a bit more active than Europe over the short term, although the conditions there are certainly ripe for consolidation as well.
Talk to us about what you're seeing in terms of M&A and how it can be a catalyst for a strong market. It seems counterintuitive, doesn't it? There's interest there, people aren't doing it, but if they do, the market will take its cues?
To a certain extent, Mark. I think what you're saying is something we've seen really over the last 25 years, is that one of the indicia of a bull market is a strong M&A market. And I think part of that is because when you have consolidation within a sector, it tends to help all the stocks in that sector. So if you have something in pharmaceuticals, you tend to see pharmaceutical stocks rise, in part because they think there are going to be more deals, but because consolidation helps everyone in the sector. So it has a bit of, it helps the cycle.
Frank, speaking of sectors, are there particular areas where you think we're going to see more consolidation than others?
Sure. Certainly, we're going to see a certain amount of financial institution consolidation. I mean, we've seen that probably more than any other sector.
Maybe on the smaller end, because we've seen a lot of on the large end, we've seen some deals happen.
I think we're going to see it, at all sizes and in different parts of financial services, and they won't just be the sort of shotgun FDIC wedding type of situations. I think we're also going to see energy and basic materials. They're going to continue to consolidate. Consumer products are going to continue. High tech is certainly going to consolidate.
Is there anywhere where there's going to be less, I guess? Because that's a pretty long list.
It is. I think most sectors will. Probably entertainment and hospitality are going to be slower to consolidate. And probably also real estate.
But you have a bullish outlook, at least in the short and long term, right?
Right. If you define the short term as sort of 3 to 6 months, yes.
Summer to the fall?
Yes. If you define short term as the next few weeks, it's probably going to be a bit slow. But if you go out beyond 3 months, I think it's going to be busy. And then even longer term, I think it's going to be very busy as well.
Could I ask you quickly, any movement by the Fed on interest rates and how that changes the playing field?
Well, clearly right now the big strategic buyers have plenty of cash, so they don't need to borrow a lot. But to the extent that they do need to borrow, and they can borrow because they have pretty good balance sheets, they're doing it at historically low interest rates. I think a small interest rate increase probably is not going to have an effect. If they did a big interest rate increase right now, it would have a dampening effect, not just because the cost of borrowing goes up, but because that's going to dampen down economic activity.
All right, Frank Aquila of Sullivan and Cromwell joining us on set. Always good to see you. Thanks so much for coming in. Appreciate it.